We have encountered territory that we have never been before. The general consensus is that this time is different, and there's certainly nothing to worry about. It's clear that without a trigger event, without a big spark, there likely won't be a fire. But when everything around you is soaked in gasoline, it doesn't take much to set it off, right? You came here for the truth, so let me unveil that for you. That's what we're going to talk about today. The central banks and their activity have basically desensitized the public to any sort of plunge. But at the same time, their activities desensitize the market to their effectiveness. So this is a big problem. And the average person just thinks, well, they'll print more money. They'll do whatever it takes. They don't want to let it crash. But I have to ask, if you see it historically, if you study their history, if you know how they came to be, you wouldn't really see it that way. But for the average person, the average investor, that's not what they're worried about. Okay, they're worried about their daily work, their 9 to 5, their businesses, and they do not care about all of this information that you and I do and how integral it is to the overall understanding of where we should be putting our time, our effort, and of course, our hard-earned savings. I've got a chart GPS video for you today. I've already done this. Now the second time I've tried to record this video because I went on 18 minutes in and didn't even make it halfway through. So I'm trying it again. I'll keep it concise. Let's go. This is a comparison between the MOVE index and the VIX index. The VIX index, of course, measuring volatility in the stock market. The MOVE index is measuring volatility in the bond market. And while the VIX index has been moving down, and the VIX index barely ever moves up, by the way, very few instances. You can see the bond index, the MOVE index here is just basically moving higher. We've seen how it has been a real, let's say, canary in the coal mine for what's been going on in the financial world. But they want to dismiss it, just like the Federal Reserve dismissed the repo crisis and literally pretended that it didn't even happen as it was going on. They said, don't worry, nothing to see here, folks. Nothing to see here, folks. And yet it was so terrible, and the entire financial system was getting real freaked out about it. You saw the reverberations occurring, and they pumped in the money and they made it oh so much better. But we're going to find out, by the way, in this year, 2021, if memory serves correctly, we're going to find out what happened at that moment, because we had to wait 2 years for all that data to come through and the Federal Reserve to finally release it. I am excited to see that, but it won't be for several months. 2 years later, you get that data, and you know there's going to be a lot of videos that I'm going to be posting about that. The creator of the MOVE Index has put together these charts as during this interview that they did with he did with Real Vision, and I just wanted to bring this one particularly to you because I thought it was interesting. Fed funds rate versus the 5-year forward 5-year rate, and whenever they touch, you tend to have a problem. 99, 2007, and 2018. And you're seeing here the Fed funds rate essentially moving higher. And as soon as it gets to that point where they touch, everything turns around. And what do? What's the response? They have to bring interest rates down. That's the solution every single time. We just have one small issue today. And that is, with interest rates at 0%, what do they do? Valuations across asset markets are high in the US relative to history. I'm not going to break them all down to you. I've shown this many times before, but you can see what's going on. The historic percentile is extremely high. Some of them are 100%, some of them are in the 90s. The median here for equity is 94%. And then at the bottom, credit and rates, the median is 91. We are looking at this, all different metrics, all different indicators, and they are showing something very clear. Today, right now, things are out of whack. I'm going to show you so many more, but measure it on so many different levels. And we are in this territory. We wonder, how do we even get here? Valuation, sector baskets. You can see what's been going on with these 4 charts. I'll show you. I have several more in the next one, and I don't have time to break them all down, but if you want, you can pause the video or you can go to the description under the sources to get all of them. All I'm trying to show you in this case here, valuation of cyclicals versus the defensives, global versus domestic, cyclicals versus the S&P 500, and defensives versus the S&P 500. All of these have made a bigger change right now from essentially 2020 and beyond. Once the market started to come back up after that surge, 2020, things have really looked a lot different. We're not at levels we have seen in other cases here, sometimes in the year 2000, sometimes the financial crisis and so on. But I'm just showing you that there has been these big changes, and they're all shown right here. Uses of cash, we have CapEx and research and development, high growth and investment ratio. Both of those are increasing, but the one I wanted to touch on is here, buybacks. You could see what had been happening, since approximately October or so. This has been going higher. Part of that, of course, was that, the financial companies were deemed so safe and so solvent that, now you're allowed to do your buybacks again. And that's been coming up. Then on this end here, you have dividend growth, which has been increasing throughout this period as well. And, this is a personal opinion, but I think the fact that dividends are increasing is a good thing because it's a direct way to give back to the shareholders who hold long term. There are some that argue that they want buybacks because they want the capital appreciation, but there's nothing better than passive income. Unlike in 2000, today the median S&P 500 stock carries a high PE. It's interesting, isn't it? You always see those examples of how high the PE ratios had become back in the year 2000, back in 2007, not quite as much. But I think it's just something to compare to, because you take it with the median S&P 500 stock and you start to realize that things are really unhealthy today. And you measure that on all these different levels, and they're not willing to admit it because they say, look, we have such a different scenario. The stocks that are high flying, there's a reason for it. People are using Zoom, all kinds today. But then you say, well, how are these companies going to make money? Oh, that's not important. That's not how is that company going to ever achieve profitability? And you just list hundreds and hundreds of big names, and they say, well, that's not a problem. The Federal Reserve is printing money. I mean, it's ridiculous. Sure, I will acknowledge. You take Amazon, for instance. You see it back in the year 2000 and you look at it today. It's a very different company. That's for sure. There's no doubt about that. But if you see what's been happening with the valuations of these companies, you should start to think to yourself, this isn't okay. It's not good. Not with Amazon specifically, all right? There's always this analysis, this strange analysis, and they always use these minor details to try and prove a point. Look at what's happening and how many companies lose money and still are able to achieve these ridiculous valuations. Do I even need to mention what's happening with SPACs today? Sure, they've come down from the peak, but it is just not normal, and generally that ends very badly. The problem is when you have a certain sector, let's just say, the SPAC index just went through the floor and it just crashes. What happens to the rest of the market? It's not contained. It's going to also perform poorly. That's the way it always works. That's my fear. More details here. Sector valuations relative to history and interest rates. They break it down by the different sectors, and you could look at it here. I just wanted to show you that, it's, to me, ridiculous to see the 30-year percentile rank right now for the S&P 500, 91%. We've gone out of whack, and nobody wants to identify this as being a problem. Percentage weight in the S&P 500, tech sector, 26.49%. Go down the list. Amazon, nearly 4%. Alphabet just behind it. Facebook, Tesla, and the total being over 37%. You have a small collection of stocks that are clearly above and beyond the rest. The attention they get, the amount of money that they're worth, that's very clear. But what's important here, and the reason I mention this, is because of ETFs. If these people who are investing in these ETFs, you got these massive institutional, massive institutional investment going in, and you could see what has been on the way up, fantastic. It's so easy. Hey, we're buying a diversified portfolio here. All we got to do is buy one ticker. We're getting a diversified portfolio. But that really isn't the case, because you can see how much of it is made up in, for example, one sector or just a handful of stocks. Yes, these are the biggest stocks. I get it. But if you see what happens in a crisis. Look, if there is some very meaningful regulation in the tech sector, this could impact the prices of these stocks dramatically. That would create a problem for those holding these ETFs. Even if you didn't want that much exposure to it, you don't have a choice. That's why if you're an active investor and you're choosing the right ones to put in there, not necessarily saying that you shouldn't have ETFs or whatever, you got to do what you think is right. But if you do it in this way, you are taking on heavy risk that is generally not understood. Okay, that's my point. S&P 500 tech sector price to forward sales, just one of the metrics which have gone to the levels or exceeded the levels of the year 2000. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. I want to thank you for that. If you want to learn about e-commerce, if you want to learn how to sell stuff online, you can do so for free, like a step-by-step program. Nothing like this exists for free on the internet. You can go out there and pay $1,000 for one, that's for sure. But nothing like this for free, I'll tell you right now. So you can check it out at the AmazonGPS.com. If you want to learn about the financial system and you want to experience everything that, the historic aspects, the foundation, the 4 asset classes, and so on, that's all in these 2 books. Definitely check them out at the link in the description. Have you seen this video yet? You definitely want to check it out. There it is. Click it, and I'll see you there.